Welcome to Captive of the Week. This is your host, Jason Shoup, founder and managing member of the Centers for Better Insurance. The story of our captive this week starts halfway around the world on Paradeplatz in Zurich, where Swiss banking giant Credit Suisse got its start some 164 years ago. The bank now employs nearly 48,000 employees from more than 150 countries to manage $1.5 trillion in assets. Last year, it paid $1.7 billion to its shareholders through dividends and a share buyback program. The year before, it paid its 12-member executive board a total of $95 million in compensation. Credit Suisse has a history with the U.S. government. In 2014, the bank pled guilty to conspiracy to assist U.S. taxpayers in filing false income tax returns with the IRS, resulting in a $2.6 billion fine. In 2017, Credit Suisse entered into a $5.28 billion settlement with the Department of Justice over the sale of residential mortgage-backed securities. But let's start back to a time before those revelations came to light. In September 2008, Credit Suisse's Delaware subsidiary incorporated Terminus Insurance, Inc. in New York. 5 years on, the New York Department of Financial Services conducted a routine financial examination of this new insurance company, which resulted in a short public report dated September 9, 2015. We will use this report to build our understanding of Terminus as it existed at the end of 2013. The report does not give us a lot to work with, and things may have changed over the last 7 years. But in the closed world of captives, you do the best with what you can get your hands on. Terminus sold Credit Suisse a $1.5 billion terrorism insurance policy covering nuclear, biological, chemical, and radiological terrorism. Under the Federal Terrorism Risk Insurance Program, Terminus is responsible for what appears to be about a $1 million deductible and a 15% co-share above it. U.S. Treasury, on the other hand, is on the hook for the lion's share of the risk, almost $1.25 billion. This risk does not stay with Treasury. Under the Terrorism Risk Insurance Program, Treasury marks up the risk by 40% to a total of $1.75 billion and drops that risk onto the balance sheets of unsuspecting U.S. small businesses, nonprofits, local governments, and other insurance purchasers in the form of future policyholder surcharges. Surely Congress would equip Treasury to carefully oversee transactions such as this. Not at all. Treasury does not even know the names of the captives participating in the Terrorism Risk Insurance Program, much less who owns them and how much risk they are moving through the program. So who did negotiate this deal, creating $1.7 billion of risk for America's commercial policyholders? Credit Suisse appointed its own executives, the same ones responsible to negotiate on behalf of Credit Suisse, to serve on its insurer's 3-person board. As the term captive suggests, this intertwined corporate governance model means the corporate parent controls both sides of the negotiation, and no one is watching out for the interests of the United States or U.S. businesses, nonprofits, and local governments. You can find out more about the Terrorism Risk Insurance Program and terrorism risk captives at betterins.org. On behalf of the Centers for Better Insurance, thank you for spending your time with us today.